Good morning. You're watching The Market right here in 18 with me, Ayesha, Faridi, Avanne, Dubash, Nikunj, Dalmia. And what a day it turned out to be yesterday. Start of a truncated week and wasn't really the best one. Yes, sure enough, we did pull back from those 19,500 sub-levels. But the kind of weakness that you're seeing with key heavyweights, cases in point being Reliance, HDFC Bank, and the consistent weakness, so to speak, that's really weighing heavy on the indexes. In fact, to add to the bag, there was also ICICI Bank and ITC as well, which did really drag. There has been overnight a sharp rise in global yields as well that you've been seeing. And once again, it was the broader markets which outperformed what the benchmark did. And it's been too consistent, this weakness in Reliance and HDFC Bank. And unfortunate as it may be, given their weightage, the Nifty can only do that much.
So, Ayesha, it's a macro adjustment. Yeah. I don't want to use the word sell-off because sell-off means that things are really falling off the cliff. It's not like a global sell-off. It's a macro adjustment given where the bond yields are moving higher. Now, before we talk about last 3 days, you have to talk about last 3 months to put things into context. And if you analyze the last 3 months, then last 3 days or last 5 days would appear more like a routine profit booking, which has originated because of rising bond yields. Why are bond yields rising? Well, when bond yields they rise, equity as an asset class will always see adjustment. Flows will move out of emerging markets, and that will have an impact on the dollar index. So the setting on the table is something which is not very difficult to understand. What may happen, and what I think is clearly evident now based on the market action, is that now you've got a roof in place. And when benchmark indices, whether it is closer to 20,000 or just above 20,000, looks like this time we have a roof in place and the downside of the market is open. So now the market will gradually drift and rediscover the lower end of the range, which may take some time. So in the near term, when I say near term, in the immediate next couple of days, the path of least resistance for the market is on the lower side. It is largely because of what is happening in the global markets, and FI selling, which is a combination of global macro as well as local profit as well as profit booking, I think is having an impact on the way how some of the heavyweights are moving. Now, it is a function of global adjustment which is making HDFC Bank and Reliance go down or vice versa. You can't judge that, but we are going through a global adjustment where in the short term the upside of the market is defined and the downside is something which markets will discover in few days.
Yeah, talking about downside, from the recent highs, the Nifty Bank has fallen about 4%, which is 1,800 points. Now, if you were to really traditionally stack it up with how much we've fallen in the previous bull market corrections, we've not fallen too much. The Nifty is less than 3.5% away from its recent highs, and the mid and the small caps are like 1.5% apiece.
Ayesha, 3-4% in the best of the bull market is more like a routine correction.
Exactly.
And I think that this market correction also in hindsight, when we will analyze it, it will be very sharp, it will be very swift and it will be forgotten. Nobody is talking about what happened to the market same time last year. So profit booking is part, or correction is part of any bull market, and it will always create fresh entry points. So how is this leg of decline different? Well, this leg of decline is different largely because global cues are also dragging it down, and the good differentiating factor for us is that the appetite into Indian equities, I think, is insatiable, whether it is from the HNI crowd or the retail crowd or perhaps from some of the family offices. So I will not be surprised at all that individual stocks, they will continue to do their good work. Earnings season, it has dawned on us, and you may be in for some adjustment here and there, but barring that, I think the whole India appeal is so strong that the downside is going to be shallow. I come back to that point again, that corrections are par for course for any bull market and they make the market healthy. But in this leg of decline, the three things will happen. I'm firmly of the view that India will outperform. I'm firmly of the view that HNI and retail appetite will safeguard Nifty and Sensex stocks from the mid and the small cap stocks from a free fall, and see the whole positioning in terms of where things are changing, I think will make India stand out.
Okay, that's the overall setup for the markets, but let's also take cognizance of what's happening across the globe because that really merits attention. It's been a losing session on Wall Street. You had the job opening data, and that has indicated that the labor market is strong, but bond yields continue to inch higher. So we did have the Dow Jones, which notched its worst session since the month of March. You had the S&P 500, which at one point hit its lowest level since the month of June, and you had the Nasdaq wrapping up close to 2% low. So that has pulled most of the indices into the red for the year. The 10-year Treasury yield, that is as well what we're monitoring, as well as the 30-year Treasury yields, both at their highest level since 2007. And the average rate on the 30-year mortgage as well has approached about 8%. The jobs data as well has bolstered a case for now higher case. And yes, for the Dow Jones, Nikunj, we've turned negative for the year 2023. So how disconcerting or how much attention should we pay to the rising bond yields and what we're seeing play out across Wall Street?
See, bond yields are at levels where they'll start pinching you. And if they go higher, they'll start hurting you. From an environment where they were favorable, now the pinch has started and then the hurt will start. To put things into context for our viewers here, rising bond yields means that the cost of capital in the world is going higher. If the cost of capital in the world is going higher, it will have an impact on the underlying valuation of equities. Also, if you are a investor, now you have an option to say, I can park capital in US bonds where I'm getting a safe 5% return versus do I deploy it in emerging market equities, especially markets like India, where I'm taking a risk because of the underlying volatility and the nature of the world. So the temptation to lock some gains or lock some investments at 5% bond yield with a perspective that interest rates will not stay up for long, I think is a very reasonable temptation, and that surely will have impact on the flows, and I think that is visible in the way how money is moving out. Now, this is not like a COVID setup where the interest rates were abysmally low. So in the hunt for yield forced everybody to come to emerging markets. I think at 5% or closer to 5%, the yields in US are strong enough, and that in a sense could be the biggest near-term challenge for flows to come back into India. We've been exceptionally lucky with flows into India this year, but of late the flows are reversing, and that is a function of profit booking and rising bond yields. So you cannot undermine the rise in bond yields. Anything above 5% is something which will start hurting flows and also the global risk appetite.
Interesting note though from Morgan Stanley this morning, talking about the India strategy, stating clearly that India is definitely one of their top picks within emerging markets, but also talking about how the calendar is packed with events with a binary outcome.
So, Ayesha, to just, to be fair, Morgan Stanley and Rhythm and his team, they've just been vocal about why they've liked India and whatever they had in a sense projected and whatever they had indicated in terms of the macro trends and in terms of the shape of the economy. I think that has really aligned with what their broader thought was. Now, of course, volatility is coming back, and the reason why volatility is coming back because valuations, the global setup, the underlying current of local events like election cycles, that really is at play, and that lead to volatility. But Morgan Stanley is also of the view that while the trade is going to be volatile, the direction is not going to be south, the direction is going to be north, and volatility is a function of events, valuations and flows. And for next couple of quarters or next couple of months, there are a lot of events, earnings season, election cycle, state election cycle, and then the valuations exactly are not at a throwaway price, and then you've got this whole interchange of what is happening in the macro market. So I think volatility is something which you need to be prepared for. There's a difference between risk and volatility. I firmly believe that there is little risk, but there is going to be high volatility.
Okay, volatility is the name of the game. Perhaps that's the take coming in from Nikunj. But let's move right on then. And in light of the rising bond yields, in light of what we're seeing play out on the indices across the globe, let's find out what exactly the outlook is from some of the top global commentators. We've got Harsh here standing by to give us a gist of that. Morning, Harsh.
Hi, morning. So, first off, won't speak about bond yields, but we'll speak about couple of big names talking about AI. We have Ray Dalio, who's saying that AI can have an enormous impact with regard to productivity. And yesterday as well, we had Jamie Dimon, who spoke about a 3.5-day work week going forward for the next generation. as a key positive, as a trend changer going forward. So AI has been in focus with regard to where the global commentary is concerned. Also, we had a couple of comments coming in from a couple of presidents of the Federal Reserve. I'll first talk about the Cleveland president, Loretta Mester. What she's suggesting essentially is that if the economy continues to look like the way it looks today, she will vote for a rate hike at the next meeting, which is around the corner. She also believes that rates will stay higher for longer. That's the indication she's giving. Also, we had Rafael Bostic, who also is chiming in very similar kind of commentary, but slightly different in the sense that he believes that one needs to wait for rates to the rate hike to really start getting built into the growth and into the economy itself, and therefore he's not in a rush to actually increase or reduce rates and keep rates as is. He's saying that, of course, with regard to a rate cut, he's expecting that in late 2024, possibly in the last meeting of 2024. That's what presidents are talking about.
Okay, let's move on, and let's also talk about the trade setup then this morning. We've got Naresh as well as Kunal joining in on the show as always. Kunal, Naresh, hi, morning. Kunal, 35% of the total weightage of the index was under pressure yesterday. Reliance, HDFC Bank, ITC, ICICI Bank. What's it looking like for the index?
Good morning, Ayesha. So yeah, I think that's the conundrum with the market right now. Because there are two divergent trends which are playing within the indices, within the overall market trend. One is on the index front. Yes, there is definite amount of weakness on the indices, as well as a good amount of, or a prominent amount of shorting, which is happening into these large cap names, specifically the ones which you've mentioned. But on the other hand, it's not as if the portfolios are bleeding, like what we had seen actually on that single day when the mid-cap index had fallen by a couple of percentage points, 2 weeks back. So, we're still into that state where there's a lot of stock-specific opportunities to try and initiate maybe fresh long. Stocks are actually seeing breakouts for themselves. There is follow-through up move for many mid-cap, small-cap tier 2 names. So, I think in that regards, one has to be a bit more stock-specific over here. Yes, the indices are showing signs of consistent weakness. We are trading below the 50-day moving average consistently over the last 3 days for the Nifty, and I think that could probably spell some concerns on the index trend. So the view is negative on the indices and expecting a further correction even going forward.
Naresh, what levels are you monitoring on the Nifty Bank, especially given the weakness in ICICI Bank and HDFC Bank, more pronounced in HDFC?
So the main level continues to remain at that 43,500 to 44,000 mark, which is where it has made the lows for the last few months. So overall, HDFC Bank also at 1,500. The major lows for the last longer term is closer to 1,400. The recent lows in March were closer to 1,500, 1,530. So out here, not a major downside, but it's been a slow drift in the banking space. But at the same time, we are looking at an Axis Bank hit a new 52-week high and an all-time high. So the structure of the bank Nifty is such that 40% of the index does nothing, which is where you have HDFC, Kotak, as well as ICICI and the smaller names. And then you have the rest of the 60%, which is where we are seeing strong trends, which are closer to 2 to 5% away from a 52-week high, which is where Axis Bank, SBI, IndusInd Bank, and the smaller names which have done really well, something like a PNB, RBL Bank, etc. So the structure is lopsided. So for now, it's a slow drift. Would be looking out for reversal signals once we start seeing a reversal in the global indices. We've outperformed the global indices by not falling as much, but we are getting into oversold zones for the whole of the globe as well. So US markets could get oversold today or tomorrow and could see some bit of a reversal. So overall, looking out for reversal on the bank Nifty.
All right, a reversal on the Nifty Bank, but let's find out what the individual stock strategies are from our charters this morning. And Kunal, are you sticking to the heavyweights?
Yeah, sticking to a few individual large cap names, DMart is the first stock which is actually showing signs of a reversal as well as a breakout. The stock crossing about that 3,700 mark yesterday. So would suggest a buy 38.80 as a target, stop loss at 3630. And the second would be buy on PNB. Many of the PSU banking stocks are seeing a follow-through breakout as well as strong volume participation. So PNB is one of the candidates in that aspect. Would suggest a buy with a target of 88, stop loss at 78.
Okay, let's find out what's on Naresh's radar. And Naresh, what are your stock-specific strategies?
So first is a buy on Indigo, which has been relatively resilient even with the rising crude. Finally, over the last 4 sessions, has given yesterday a reversal signal by making a 3-4 day high about 24.20, looks like a short-term reversal is in place, and we could be looking a bounce towards 2550 levels, a stop loss at 2360. Second is a buy on State Bank of India, and the stock has consolidated well. Yesterday, it gave a breakout move above 600, but structurally, it has made multiple tops around the 620, 630 mark over the last 1 year. I would expect it to break going forward. So a buy at current levels as well as on dips, stop loss at 585, an initial target price of 640.
Okay, let's talk about stocks that you need to keep on your radar, and let's talk about the very few winners yesterday. And case in point being Bajaj Finance, which of course, led the charts yesterday. The AUM growth along their Q2 update has come in strong, and it's come in above the previous guidance. Anisha is here in the studio. Anisha, tell me, brokerages must be loving it.
They're loving it, and Bajaj Finance is as it is a favorite, so no surprise then that we have seen target price upgrades come in yet again, and they are very confident that the company will be able to beat its own guidance. Remember, they were talking about 29 to 30% kind of growth earlier. Now they are expecting, the brokerages are expecting that there could be at least 33 to 35% kind of growth. And of course, we're not talking about a small microfinance player here. It's Bajaj Finance, and the book size, of course, is very large. But nonetheless, Street is now expecting 33 to 35% kind of AUM growth. And the target price by Morgan Stanley has been increased to 10,300. It's a good quality of increase that has come in. Overall loan growth has also been ahead of estimates. You also look at the new loans that were there. New customer acquisition stood very strong, 37% higher year on year. Even if you look at the total customer franchise, that stands at 22% growth year on year. The deposit base also grew by 10%. So overall, a very positive set coming in. And to add to that, of course, there's that meeting which is impending of the capital fundraise, which is going to happen tomorrow. And looks like they're going to use this growth capital to accelerate growth, because they're already doing 30% plus, Nikunj.
Ayesha, this is one company which is Bajaj Finance is exactly doing what HDFC Bank did, let's say, 10 years ago. It was like the darling of the market, but it kept on surprising everybody irrespective of the NPA cycle what we were in, and irrespective of the large base it had become. So these are just rare companies when you find where they are able to grow, and they're really able to grow at that large base. Having said that, the interesting bit for Bajaj Finance is that growth is supreme. And Anisha has outlined all those individual growth parameters. I would just like to point out one fact which I don't think anybody is talking about. None of the brokerages also Anisha mentioning, is that Bajaj Finance valuations are cheaper than what they were during IL&FS crisis. And they're cheaper than what they were in pre-COVID. Here's a franchise or a NBFC which is growing, which is demonstrating their ability to manage large numbers with a low LNPA. They are using big data in order to forge ahead, and valuations are just not pricing in any kind of a cherry consensus. So there is a cherry consensus that you should own Bajaj Finance, but the valuations are not suggesting that. So which means that in the near term, the stock to actually catch up and let's say go back to levels which it had originally enjoyed, I think will not be a very difficult scenario. So more than the earning expansion, I think now there is case also for the price to book or valuations also to catch up. So if you're looking for a ranked outperformer in the second half of this year, I think it really could be Bajaj Finance. And the second part, which I'm surprised nobody's talking about it, is that look, when the bond implication will start, who will benefit? The bond market will benefit. And companies like Bajaj Finance, which tap in very smartly into the bond market, and they have a very strong ability to raise capital, could be biggest beneficiaries of what is going to happen once this entire bond inclusion will start. There are two factors I think which are very crucial, which nobody is talking about. So I just thought I'll bring them out. One, valuations are not pricing in any kind of cherry consensus, and second is that the bond inclusion is something which will have very strong implications for a franchise like Bajaj Finance when they will go to the market next time to raise more capital.
The cost of funds will definitely come in lower when, of course, there'll be more.
All that money which will come from the bond market, where will it go? It has to go into franchises like these. And if everybody is so gung-ho on Bajaj Finance, then why valuations are below pre-COVID? They are. Pre-COVID and even pre-IL&FS, which means that it can go higher.
Okay, that's the view coming in on Bajaj Finance, but let's also discuss an IDFC First Bank as well. That stock is in the spotlight in trade today. The QIP news, Anisha.
Yeah, it seems like it's a ditto of what Bajaj Finance is doing in the NBFC world, what IDFC is doing perhaps in the banking world, because they are also raising capital which they are going to use for fuel their expansion going forward. It's a QIP of a total of 3,000 crores, 2,000 crores is the base size with an green shoe option of around 1,000 crore, but the kind of demand that we have heard from on the street, it looks like that the bank would be able to do the QIP of full 3,000 crores. Yes, the price is at 4 to 5% discount to yesterday's closing price, but we are expecting that given the demand is so high, the stock will catch up during the course of the trading session as well. Remember, the capital adequacy ratio for the bank continues to be quite solid at 17%. They have given a guidance of growth of loans to the tune of 23 to 25% year on year. Have a quite a diversified book, and whatever were the legacy issues are over. So looks like IDFC First could also be one of those candidates, but the differentiating factor here that it's run up quite a bit.
Also supply. See, they had the promoter sold off to one large fund, GQG, and then on top of that there is another QIP. So suddenly there is a lot of supply which is now come to the market, and the institutional appetite at a time when banks in general are weak. I think the institutional appetite when you have two large, supply, instances or two supply, cases may just in the near term be slightly less from institutional investor standpoint. But if you look at the franchise, I mean, same time last year, nobody believed that IDFC could be such a turnaround candidate. And it has demonstrated perhaps on all ratios. And I don't think that markets have fully understood the potential of the value of this franchise. It's not very expensive. B, they've got a lot of triggers in the near term which can still turn things around. So while the CASA is on track, NPAs are on track, the cost to income ratio is is something which could be the new lever for IDFC Bank going forward. So I think both in terms of the operating leverage and also in terms of the growth trajectory, they are going to be benefiting because of that. So I don't think in terms of an IDFC you may talk about, I don't think this is like markets have rediscovered and markets are well aware of all the good things. There are still multiple levers which are at play, which I think will continue to benefit IDFC. But in the near term, just because the supply has been so strong from the promoter first and now a QIP, there could be a case of a demand supply vacuum because of the liquidity supply. But if I take a medium term view, I think this franchise has potential to keep on getting surprised with the ability of with the strength of the franchise. And like I said, there are a lot of multiple operating leverage, kickers which are at play.
Okay, that's the take coming in on Bajaj Finance as well as IDFC First. Anisha, thanks for flagging off both those stocks. We're going to take a very quick break. Let's just revisit what the GIFT Nifty as well is up to, and it's indicative of some more downside for us, about almost 135 points. That's the Nifty implied open adjusted for the GIFT Nifty and how we shut shop yesterday. But here's a take coming in from Gautam Shah talking about as to how the pharma sector could make a big comeback.
So we love IT. I think we've been a big bull on the entire IT pack for a while now. We maintain that stance. And I feel in a difficult market environment, IT will stand out. And this 31,000, 31,500 area is an important support. Secondly, I think the sector that we feel could make a big comeback is pharma. I think it's very clear looking at Friday's action that the market has got into risk off mode. For the last 4 months, we were in risk on mode. So everything and anything that was high beta did well. Now, I think we've moved to risk off mode. And I think pharma could be a sector that could lead the market move from here in terms of strength, sectors doing well. And I do see the pharma index appreciating 15% from here. So our working target is about 17,000. So these two spaces look great. And autos, I know it's considered high beta, but if you really carry in the fundamentals and the technicals, I feel auto has the potential to be the big structural story for the next 6 to 12 months as well. Now, if you have a 3-year view, I'm still very comfortable to hold on to PSU stocks because I think they'll do exceedingly well and they will outperform the benchmark indices by a wide margin. So in that sense, we love the setup of NTPC, Coal India, Power Grid, ONGC. I think it will do great things over a 3-year period.
Welcome back. Still tuned into the market. Let's move right on then and put the spotlight on more news and updates. And the Finance Ministry has cleared about 60,000 crores of incentive scheme for urban housing. In fact, we've learned from sources that the proposal of the Housing Ministry has been sent for cabinet approval. My colleague Prakash Priyadarshi joins in with those updates. Prakash?
Yes, an important development coming in as government is well set to launch a new home loan scheme for urban poor and middle class. So we are learning from our sources that the Finance Ministry has cleared the proposal of Housing and Urban Affairs Ministry. We are given to understand that the Expenditure Finance Committee of the Finance Ministry has approved approximately 60,000 crore as an overall financial outlay for this scheme. So it's an important development coming in as far as housing sector is concerned. Sources are also saying that it is now up to Indian Cabinet to give its nod to this scheme. However, final approval from the Indian Cabinet is expected anytime soon. Moving ahead, we are also given to understand that as per the proposal of the scheme, government is planning to provide benefits of interest subvention to the urban poor and middle class under this scheme. Consumer can get benefit of interest subvention on housing loan up to rupees 50 lakh. In addition to that, when it comes to benefits of interest subvention, that would be in a range of 3 to 6%. So that's an important development coming in. Apart from that, sources are also saying that the scheme is going to be different from previous CLSS urban scheme. Size of the houses and so as loan amount would be higher under new scheme. As you are aware that the Prime Minister has already announced this scheme from Red Fort on August 15, and now the efforts are being made to launch this scheme formally.
Thanks very much for those details. Meantime, banking behemoth HDFC Bank, they've decided to revamp the management. This move comes about 3 months after the mega merger was announced with HDFC. Let's understand a little bit more about what the reshuffle entails. We've got Ankur here to take us through the entire reshuffle as well as the rationale behind this move. Ankur?
Yes, HDFC Bank has made changes in the top leadership, and this has been done to enhance its focus towards the leadership which it is aiming to. In fact, these business decisions has been taken so that it is aligning with their business strategy. The change which is notable here is that CIO Ramesh Lakshmi Narayanan will now head the entire IT and digital business of the bank, and till now this division was headed by Parag Rao. Now he will also directly report to MD and CEO. This has been done because HDFC Bank has been focusing on the digital revamp for a while. Remember, in last 2 to 3 years there has been several initiatives which has been taken by the lender, and so as to enhance their focus on digital, this revamping has been done. Apart from that, Parag Rao will continue his existing portfolios of payment as well as consumer finance, but additional responsibility has been given as far as marketing and liability product group is concerned. Apart from Parag Rao and Ramesh Lakshmi Narayanan, the Deputy MD Kaizad Bharucha will also manage inclusive banking initiatives, group CSR, as well as ESG strategy. Group head Arvind Kapil to spearhead the mortgage business, and also Arvind Vora, who was earlier responsible for retail branching of the bank, now he will be moving as group head of retail assets, but this will be minus the mortgage which will be headed by Arvind Kapil. Arvind Kapil and as well as Arvind Vora will directly report to MD and CEO. So all these changes has been made as stated by HDFC Bank MD and CEO to employees, that the change is being done to bring in a very sharp focus on leveraging what they have been trying to build for enhancing the execution. So this is the message which has been given by MD and CEO on the changes. The idea is clear. After the merger, the execution is the key for the bank.
All right, thanks for that. That's the latest with respect to the reshuffle with HDFC Bank. Moving right on then, in the latest strategy note, Morgan Stanley remains bullish on India, saying that it's one of the top picks among the emerging markets. Let's understand the highlights of this note and what's driving the optimism. We've got Anisha here to sum it up for us. Anisha.
Oh, well, yes, Morgan Stanley is talking about the trade which is going to be a bit of a certainty. This quarter is going to be high volatility. So what they're asking investors to do is to get ready for higher volatility this time around, because they are saying that this quarter is very heavy with events which are pretty much binary in nature, and that is coming at a time when volatility right now is low, and going forward it is expected to increase from here on. Having said all of that, the fundamental story of India still remains pretty much intact for them, and that's why it's one of the top picks in the emerging markets. markets, a lot of factors which actually make them positive on India. That's the stable non-portfolio foreign flows, strong earnings growth of over 20% for the next 3 to 5 years, and then of course the emerging private capex cycle and the fact that the corporate balance sheets look very healthy right now is all something that makes them very positive on India. Of course, there's a structural rise in the discretionary consumption as well and a reliable source of domestic risk capital, and all of this is keeping them very positive about India. They say that because of all of these factors, the correlation that India has to the rest of the emerging market as well as what is happening globally has come down. In fact, India's beta to emerging markets now stands at lower than 0.4 times, given the fact that dependence on FPI flows has come down very sharply. And that's why in their base case, they expect that the market will rise into election as it is likely to price in continuity and a majority government coming back. Having said that, they are expecting some sort of volatility, so that will happen on account of oil prices, the bond flows, the monetary policy action, politics, etc. They prefer cyclicals over defensives, prefer large caps over small caps and mid-cap names. Within sectors, they're overweight on financials, technology, consumer discretionary and industrials. For rest of the they are underweight right now, and they are saying that the macro trade is approaching near its peak, and going forward you have to be a lot more stock specific. So that's the latest messaging coming in from Morgan Stanley.
Okay, Ayesha, we leave it at that and stay put with the Q2 updates. Let's center our focus on banks. The likes of Bank of Maharashtra, South Indian Bank and many more have come out with their second quarterly updates. Harsh is here with a list of all those. Harsh?
Well, yes, solid set of numbers overall when you're looking at it in the banking context. But let me start off with Yes Bank to start. First off, you're seeing good deposit growth traction coming in from Yes Bank. Now, mind you, Yes Bank had one piece which was a bit concerning. Your loan to deposit ratio had gone above 90. That's fallen below 90 now because the deposit growth has really seen a significant bump up. You've seen deposits go up by 17% year over year. You've seen a sequential uptick of 7% on the deposit front. Advances too has grown a solid 10% year over year and a 5% sequential uptick on advances. Your CASA growth has also been extremely robust. So definitely keep Yes Bank in focus today. South Indian Bank switching over. You've seen a slightly more muted performance from South Indian Bank. Advances growth at 10%, deposit growth also roughly 10%, matching it. Of course, well below what the general market is growing at. CSB quickly switching over, 27% growth on the advances front. 6% uptick sequentially as well. Deposit growth also very healthy at 21%. Of course, both of those at a lower base. CSB is a relatively smaller bank, but the strong growth continues for CSB. Bank of Maharashtra too showing its colors, 24% growth on the advances front, 22% on the deposits front. Very good matching of deposit growth with advances. You're seeing good CASA as well, and across the board it's a solid performance there, so keep that one in focus. Also, AU Small has come out with its quarterly update as well. 24% growth on the advances front, slightly more than what we've seen AU Small do, which is 30% plus over the last few quarters, but 24% is solid nonetheless. And deposit growth of 30%, 9% growth sequentially on the deposit front. Definitely that one is a positive. So moderate growth on advances is how I would term AU, with deposit growth mobilization quite solid.
Okay, Harsh, we'll leave it at that. Banks and more banks to keep on our radars this morning. Let's also welcome on board Hemang Jani to join in the show and talk about what stocks he's liking and not liking. Hemang, hi, morning. Can't help but talk about Bajaj Finance first. The fact that the AUM growth in the second quarter update has come in above the previous guidance as well, so beating all expectations. You think a good time as any to add more to of Bajaj Finance in one's portfolio, given that it's valuation-wise quoting less than pre-COVID levels and even the IL&FS crisis?
Yeah, good morning, Ayesha. I think very strong business update coming through from Bajaj Finance across parameters, be it customer acquisition, the new loan growth, almost about 26%, AUM growth, again, much ahead of expectations. And our sense is that, though valuations have been a bit of a concern for Bajaj Finance for a while, the fact is that in terms of delivery, in terms of asset quality and the overall operating parameters, Bajaj Finance has consistently delivered. Also, the recent fundraise that the company is undertaking would also help in terms of the book value. So, we continue to have a positive bias on the name. One should really wait for a bad day in the market when you see, correction. Let's say today morning, we are kind of staring at some, about almost 1.5% kind of a cut in the indices. So, whenever you see a bad day, I think Bajaj Finance one could surely look to add into the portfolio.
Okay, that's the day coming in on Bajaj Finance. Wait for a weak market day to buy into the stock or add positions further. Can't help but talk about what was going on in autos yesterday. Irrespective of a steady performance for the monthly sales data, the likes of Ayesha fell 3.5%, Maruti was down over 2%, and similar was the case pretty much across the board as well. Hemang, you think the heydays of auto rally are behind us, or do you think one should only use days like yesterday's weakness to add positions into auto names?
I think we should bear in mind one is that this is just the beginning of the festive season, so the monthly numbers do not necessarily reflect the underlying growth that we could possibly have. And for many of the companies, particularly the two-wheelers and the passenger vehicles, the festive season accounts for almost about 40% of the total sales. So that is something that we should watch out for. Having said that, the monthly numbers, there was a bit of a disappointment when it comes to Eicher, Maruti, some of the tractor companies, Mahindra's tractor, as well as Escorts. Whereas we have seen TVS delivering decent set of numbers and also Ashok Leyland delivering slightly better than market expectations. So it would make sense to have overall positive bias on the sector with the particular names that we prefer within that be Ashok Leyland, Tata Motors and Maruti. I think these are the three names that one can really go with.
All right, that's the view coming in on the entire auto space. In the meantime, also wanted to get in your take then, Hemang, as to what the outlook is within the entire banking sector, just owing to the fact that there have been a slew of updates that have come in, the likes of Bank of Maharashtra, Small, South Indian Bank, Yes Bank, etc. Have there been any standouts?
Business updates are reasonably good. I think particularly for the names like RBL Bank, we feel that the update was particularly very good, and one is getting the sense that the growth from here on will be very good, along with the fact that the valuations have been very supportive. So that is something that we should be looking out for. Also, banking and financial services, the Q2 reviews also start flowing in. And we think that this quarter should be reasonably good, particularly for the smaller PSU banks like UB, Can Bank, Union Bank, etc. So one should really watch out for pockets of outperformance over there. And as far as the large private sector banks are concerned, I think it's going to be reasonably okay. But because of the kind of sentiment which is around us and FI holding being at a higher level, I think HDFC Bank or ICICI Bank could go through a bit of an underperformance.
Let's revisit some of those stocks on the charts as well. And Kunal, let's start off with Bajaj Finance. The AUM growth has come in above the guidance range, that of 29 to 31% for FY24. The long-term guidance was 25 to 27%. Most brokerages are now upgrading the stock. Given that even in yesterday's weak market, this was a resilient one, what is your reading on the charts?
I think this could be an exceptional turn of events for Bajaj Finance because, at a point when the markets are or the Nifty struggling below its key averages, Bajaj Finance is now in touching distance of breaking past the all-time high levels. I think if I'm not wrong, 8,050, 8,060 approximately is the life high levels for Bajaj Finance. The stock has closed just about a percent and a half below those all-time high levels, which means that today we could probably expect the stock to make or to show the signs of a breakout as well as making all-time high levels for itself. And the best part about the charts for Bajaj Finance is not the sudden rise which the stock has shown. The last 3 months have been particularly very fruitful for the stock price. From the month of July, when the stock was sub the 6,500 odd mark, I think from there on we've actually seen the stock moving up steadily, bouncing off from its 200-day moving average, initially scaling past about 50 DMA and now on the verge of breaking past above its life high level. So I think it's an excellent kind of a chart. It's stood the test of time over the last over the last decade and more. And I think even at current levels, it looks quite ripe for a fresh breakout.
Okay, that's the take coming in on Bajaj Finance. By the way, Avenue Supermart, there's a Morgan Stanley note this morning saying that there is some improvement in the growth trends. In fact, let me take it across to Vinny and find out what is the Q2 update from both V-Mart as well as D-Mart. Vinny?
And absolutely, Avenue Supermart. Let's look at the Q2 updates, Q2 FY24. When you look at it, revenue on an overall basis, when you compare it, is up by 19% on a year-on-year basis. But overall, seems like the revenue pace is a bit slow even as of now. And obviously, what we're seeing the revenues coming in at is around 12,300 crores for Q2 FY24. That's the provisional update that has come in. Other than that, in terms of, when you look at it versus the pre-COVID levels, yes, on an absolute term, it's much higher. It's one of the highest. But the pace of growth seems to be slowing down. Also, store addition, when you look at it, seems like the pace of growth is sequentially an improvement that we're seeing coming in over there. And the company has managed to actually add 9 stores during this quarter. So, yes, pace of growth for D-Mart in terms of store addition, that has improved. But revenue growth pace, that has slowed down. Revenue per square feet, that's inched up by 6% on a year-on-year basis, inching towards the pre-COVID levels, but significantly below that mark as well as of now. So, yes, a one to watch out for over there. The total number of stores for Avenue Supermart now stands at 336 stores at the end of September 2023. For your CAGR sales also, when you see it, it's marginally seen a rise, but overall slow pace of growth seems like versus the previous years. Keeping an eye on that one. V-Mart too seems like total revenue from operation has seen a growth of around 8% this time. The new stores that they've added is 6 stores that they've added, and mainly income from LimeRoad, that is a digital platform, that has seen a growth of around 24% on a quarter-on-quarter basis, coming in at 22 crores. And mainly the shift in the festive season from Q2 to Q3, that could lead to a delay in terms of sales from Q2 to Q3, and Q3 could see better sales, is something that is a highlight coming in over there as well. So let's keep an eye out on both these retailers, D-Mart as well as V-Mart.
All right, thanks very much, Vinny, for giving us those updates. Any commentary then, Hemang, as to how you're looking at some of the latest updates from an Avenue Supermart, a V-Mart, all of these within this space?
But there is a sense that now the growth is stabilizing, and the fact is that because of the larger format of the store size where the company is focusing upon, the overall growth in terms of revenue per square feet is showing much better traction versus what we have seen in the last 3 or 4 quarters. So, though the valuations continue to remain on a higher side, I think given the fact that slightly better growth has come through in this particular quarter, one should really look to add into this Avenue Supermart for, let's say, 1 year kind of a time frame.
Okay. Meantime, I was just curious to get in your take on Vedanta. Given the fact that there's been a lot of news and developments, the latest being the demerger, and reports are indicating, Hemang, that the lenders are unlikely to clear this demerger in a hurry because it is likely to reduce the fungibility of cash flows across the businesses. Of course, there are latest updates with respect to the aluminium production updates, etc. But how are you looking at Vedanta given the fact that in this year it's declined about 25%?
So when it comes to demerger, I think it looks like some kind of an attempt to divert attention from the core issue that the company is grappling with, which is at the parent company level. There is a gap between the amount which is required to honor the debt commitment versus the current cash flows, right? So I do not think that demerger by itself will kind of address that concern. Secondly, when you try to split up the companies into, multiple units, and since it's essentially a commodity-based business, there is going to be a challenge to deal with the cash flow of each commodity depending upon the cycle. So, I would feel that in the current macro situation globally and, to some extent in India, it would make sense to stay away from names like Vedanta and focus on some of the domestic-oriented stories where you have a slightly better growth visibility.
Okay, that's the take coming in on Vedanta. Let's also address another set of stocks in the upcoming semi-annual recategorization by AMFI. Several stocks could actually see a rejig, while the likes of Polycab, Macrotech, could become large caps. JSW Infra and Suzlon could become mid caps. In fact, the official list is only going to be released in January, but Sharad is here with more details on what brokerages are expecting from this retake. Sharad?
Well, yes, AMFI's semi-annual categorization would be in focus, and do remember the official list will be coming next year in January 2024, and this will be applicable from February to July 2024. Now, as per Nuvama, the potential large cap entrants includes the names of Polycab, Macrotech Developers, Shriram Finance, PFC, IRFC, and also making it to the list is G Power, IRFC, Zydus Life, and also the newly listed Geo Financial Services. Now, also looking at the stocks which could actually move from large cap to mid cap, we have names such as UPL, IRCTC, PI Industries, which would be in focus, and also Tube Investments, Hero MotoCorp, and Canara Bank, which could actually see a categorization coming in from large cap to mid cap. If you look at the stocks which are potential mid cap entrants, we have Mazgaon Dock, Suzlon Energy, SGVN, KEI Industries, the stocks which have rallied recently, and also the names include Exide Industries, Credit, Axis Grameen, JSW Infra, and even Imami. Now, also if you look at the new listing from JSW Infra, they are also expected to come in as mid cap, but there are certain stocks which should be actually categorized from mid cap to small cap, and as per Nuvama, we have the names such as Aarti Industries, Whirlpool, Pfizer, and even Rajesh Exports. The stocks other than that also included in the list includes ABFRL, New India Assurance, Bharat Dynamics, and lastly Atul and Laurus Labs as well. But do remember, there are no proper inflows or outflows coming in. This is just for the classification.
Thanks very much for giving us those latest updates. Meantime, Hemang, what's the view when it comes to the IT sector? The latest JP Morgan report says that they are very negative on this space, largely owing to the fact that there's no convincing signs of enterprise tech spend recovery coming in, and the demand trends look very mixed. Where do you stand? What would you pick out if you were bullish on this space?
This quarter in particular for the IT services will remain weak, because the way the macroeconomic uncertainties are continuing in US, there is going to be an impact on the discretionary spending. So when it comes to the large cap IT firms, I think the quarter-on-quarter growth is going to be deteriorating, and the average growth could be somewhere around about 1.5% or thereabouts, with some companies reporting even negative quarter-on-quarter revenue growth. For the mid-cap companies, the growth would be slightly better, but one would really have to take a very company-specific view. I think in terms of the valuations, because of the kind of underperformance that we have seen over the last almost 15 months, there is going to be a comfort, but one should really look to buy into it when you see initial knee-jerk reaction when the company announces the numbers. Because I think the underlying growth potential is something that we need to assess before we really kind of take a broad call on the company.
Naresh, what are you making of the weakness within autos yesterday? And do you think we could see some more ease off in the likes of an Ayesha, Maruti, Tata Motors?
So in terms of stock specific, Ayesha is something which gave some indications of a breakout but faltered right away. So that would be one which could continue a little bit lower towards the 3,150, 3,200 mark. Tata Motors also has been finding resistance around that same band of 640 to 650, but 590, 600 remains a support, so that is where it could go towards. The interesting name is Maruti, which is where we've seen a structural breakout happen around that 10,000 mark, which was the 2018 highs. So this dip, if it comes closer to 10,000, 10,200 should be bought into. But yes, yesterday's price action and over the last few days, we've got some hints of, some bit of a correction to continue in the auto names. And even after that correction, they'll remain outperformers relative to the Nifty. So in this dip, one could start looking at, some of the names like a Maruti, Ashok Leyland on dips going forward.
Okay, fair enough. Meantime, on the charts, wanted to get in your thoughts, Kunal, on Westlife Food World as well as the Lemon Tree Hotels, both buzzing yesterday.
So Lemon Tree is something which I think over the last 1 or 2 weeks I had highlighted on the Chartbusters, indicating that the stock was getting into a breakout mode. 112.13 I think was the breakout point for Lemon Tree. The stock has done reasonably well post those levels, and I think if I'm not wrong, it's also managed to bounce off from its 50-day moving average at that 110.12 mark when stock showed signs of a near-term bottom in place. So I would believe that the stock should see a follow through. I think even Chalet Hotels is something which has looked very attractive, and the stock has actually been or has shown a slight edge with respect to the price performance as compared to even the likes of Indian Hotels as well as Lemon Tree in the very near-term charts. Westlife, on the other hand, the stock again has trying to show signs of a short-term support. I think 925, 940 is a strong support level for Westlife. This also coincides with the 50 DMA for the stock price. It's some distance away from breaking past about the previous highs of 1000, 1020. So hopefully in this leg of uptrend, if the stock doesn't break below the supports of 920, 940, we can expect 1000 plus levels as a target for Westlife.
All right, fair enough. That's the view coming in on some of those buzzers in yesterday's trading day. On the flip side, though, there were names like a Delta Corp, something like a Spandana Spurti, or even a Siemens that were rather tempered in yesterday's trading day. Hemang, curious to get in your thoughts. What's the outlook on the cap goods space, the likes of a Siemens, etc.?
I think within the cap goods space, I think what stands out for us is L&T because of the recent business updates and the fact that, this open offer which got concluded, the floating stock from the retail side has reduced considerably. And, different business verticals are showing good traction. So L&T would be the number one pick. And apart from that, I think the sector may go through a little bit of correction, and depending on how the quarterly numbers pans out for companies like Siemens, ABB, and whole host of mid-cap companies, one should be able to kind of, take a call based on the inputs. But overall, we think that the capex cycle is surely looking good, and typically in an election year, these companies and these sectors tend to do very well. So one should have a positive bias on these names.
Hemang, clearly, it's PSUs which across the board have have seen the maximum gains, right? The PSU index has been the one which has held through the market volatility all through the month of September and even right now. Which pockets within PSUs are you most comfortable with in deploying fresh money right now on the market dips?
I think when it comes to PSUs, there are diverse sectors and companies. So I think it would be prudent to really look for some of the smaller PSU banks like BOB, Can Bank, Union Bank, Bank of India, because the recent inclusion of India's weight increase on the JP Morgan bond index, there is going to be some impact on the bond yields, and the PSU banks will be the biggest beneficiary of that. Apart from that, you're seeing a good traction on the operating parameters, loan growth, asset quality wise, they are better placed, and the valuations also continue to be around 0.6, 0.8 times. So this is one pocket which we would be most comfortable with. As far as other sectors are concerned, I think it would be prudent to kind of look at each company. Like for example, defense and railways have really run up big time, and I think the valuations are far beyond the comfort zone. So not too comfortable entering into those names at this stage.
Okay, that's the take coming in on PSUs. I'm going to pick up that conversation on PSBs with Kunal in just a bit. But let's first get in some fundamental ideas. Hear it out from Sanjeev Haseen as well as Varun Sabu.
I think the opportunity lay 3 months back when you could get HCL Tech closer to 1100, or maybe we picked it up at 950, or a Tech Mahindra closer to 1050. We are overweight Tech Mahindra and HCL Tech. Persistent has been our star player in the whole basket, but we remain focused on these three stocks. You can add a Coforge because now there is no promoter, and sooner rather than later you could hear some corporate development. But yes, it has a proxy of a tailwind of a weak rupee, and I think that most of the headwinds regarding bonds and others are getting slowly priced in. You cannot have bond yields at this rate and stocks where they are. So the markets are actually pricing in that the Fed will turn bear, dovish faster than you thought. And I think the bark is always worse than the bite. So yes, we are overweight HCL Tech, Tech Mahindra, and Persistent. We've added Coforge in this decline.
On the small mid-cap side, if you want to know an idea, I think I'll be very positive on a stock named EMIL, which we covered. So electronic marts is something which I'm very positive on. Apart from this, we are very positive. So we are working on some companies, don't have coverage yet, but yeah, we have seen some names which are looking quite promising, something like a Stylem, something like a Venus Pipe, etc. So yeah, we are evaluating a lot of names, but yet to have a formal coverage on those. But yeah, things are looking very promising from a small mid-cap side still, the way businesses are.
Okay, a lot of stocks which are going to be in news flow on account of the Q2 updates as well, right from an Avenue, Supermarts, Bank of Maharashtra, etc. But the other stock which we were talking about yesterday was also JSW Infrastructure, given the kind of listing it saw, and today Updata Services will get listed on the bosses as well. Hemang, from the recent IPOs that we have seen, and there have been quite a few, which are the ones that you like or still think that there could be some value on the table?
I think JSW Infra definitely looks quite interesting. Even the presence it has, the port and port infra, and the kind of order book and the growth visibility that it offers. Though it is not exactly cheap, but typically when it's a new company, people are willing to kind of give a slightly higher valuation for a certain growth delivery that the company can possibly give. So JSW surely looks good. We used to have a positive bias on the other cable company, which got listed, but I think it has run up quite a lot now. So I think we should wait for some correction, over there. But overall, I think the IPO space continues to look good. You will have certain interesting pharma companies which will get listed. I think it is on the SME side, Valiant Pharma, that also is looking quite interesting. So I think despite the fact that we're seeing a bit of a challenge comes to the index and the global markets, I think the broader market and the IPO part of the business will continue to see good action.
That was about the pharma space, of course, JSW Infrastructure, which looks quite interesting. But Hemang, did you get a get the time to go through the numbers of Avenue Supermarts, the update that they have come out with? There is some sign of improvement from here on. The valuations are very cheap, below 60 times, and I'm calling it cheap just by its own historic average here. Do you think the institutional investors will be flocking back to this one?
I surely think so, because the revenue per square feet, which remains subdued in the recent past due to the addition of the large store size and the weak discretionary spending, there is some degree of pickup over there. And we think that, and these valuations down, the comfort will not be much, but for, somebody who's delivering and where there is a decent amount of growth visibility because of the higher store addition, I think it would make sense to add into Avenue Supermarket at this price for a maybe 15 to 18% kind of an upside.
Kunal, is that your reading on the charts as well for Avenue Supermart, that one could make 15 to 20% returns if you invest at the current levels?
Well, I think slightly higher returns is what I would expect for DMart, because my expectation is that the stock is ending almost a 3-year of correction consolidation. So it started off from DMart, I think making a high of 5,400 plus in 2021 second half, if I'm not wrong. From there, the stock corrected, came back towards, I think, 3,200 to 50 odd mark. That was the low the stock had made. And then over the last 6, 8, 9 months, the stock tested this level of 3,200, 3,300 mark multiple times, failed to breach below those levels convincingly. So it's seen a price correction, it's seen a time-wise correction. And now the stock is showing the first signs of reversal for itself. This, I believe, should be a big reversal for DMart. So for short-term traders, you may probably keep the target range of 10% approximately, plus or minus a couple of percentage points, depending on how the momentum shapes up. But I would believe that the stock should be in line of breaking past about the previous life highs of 5,400 plus levels as well.
Wow, fresh life highs coming on Avenue Supermarts. Quite a bullish call. But, in a similar corollary, if I can ask you that, Hemang, a view on all of these QSR names, this morning, of course, there were headlines talking about how Domino's has reduced the prices up to almost 50% on account of this entire volume uptick that they're expecting on account of the World Cup as well. There's a note today from JM Financials talking about how Zomato is expected to show a modest improvement in operating performance in Q2. Do you think this is all priced in, or there's still some upside?
Surely think that there's going to be a significant upside for the QSR names, particularly Jubilant Foods, Devyani. These are the two names where we have a positive view. And aside of the World Cup, where there's be some amount of traction on the business, I think the core story, the penetration, the kind of upside that we are seeing because of the traction of the festive season, there's going to be a lot of interest in this theme. So I think one should surely buy into it, and also quarterly numbers which these companies will deliver. I think there is going to be a significant surprise versus the consensus. So we continue to have a positive bias there.
Hemang, on that note, we'll let you go. Just wanted one clarification. You said Devyani, and which was the second stock?
Jubilant Foodworks.
Was it Jubilant Foodworks, Hemang?
Jubilant.
Okay, got it. Got it. Jubilant Foodworks being the other one. Good to speak with you on the show. Thanks so much, Hemang, for taking the time out. Let's move on and let's get in some mid-cap ideas going on that note, considering they are the ones which are seeing gains and performing much better than the large-cap counterparts. Naresh, what's on your list?
So that we have buy on EIH Limited, East India Hotels. The stock gave a multi-year breakout above the 220-230 mark. 220 was the high back in 2018, and roughly 220-230 used to be the high in 2006-2008 as well. Gave a breakout, saw good volumes, went up to 275. Did a retest of 220 levels a couple of days back. And yesterday was a reversal signal. This is a good zone to buy. A good retest and a multi-year breakout. Expecting again a move towards 270 to 300. A stop loss at 220.
Right. Kunal, what's on your mid-cap radar?
So that's a buy on Parag Milk, the stock breaking past about the previous highs of 220 yesterday. Would suggest a further buy for the stock, targets of 234, stop loss at 215.
All right, there you have it, top mid-cap trading recommendations, a quick look at the pre-open rates, and for now, it's indicating that it could be a bit of a softish start, down about 0.2%. But let's get a move on then, lots more to discuss as well as we delve into some more khabar then, Ayesha.
Yeah, and Sharad is here. Bata, it seems, that's going to be in focus today. Let's quickly take it across to Sharad and find out why Bata, Sharad, is going to be in focus.
Well, yes, in focus we are having Bata, and the buzz is that there is no end of season sale coming in for the company. Now, this has been there purposefully done by the company so that they actually focus going ahead, especially on the margins front. And also the channel checks which we did, we saw that there has not been any massive price cuts coming in. This is coming in just before the festive season. Of course, there has been an impact. Of course, the demand normalization because of a pent-up demand seen last year. So now, overall, the street is estimating that the demand normalization would be there in the first half of this fiscal year. Also, the company is expected to increase its margins going ahead, and there are some cost structure reducing initiatives being taken, and this is coming at the distributor level as well as across the store level. Also importantly, we did check the Bloomberg consensus also. It's still, we could say, roughly only 54% of the total 22 analysts who are tracking the stock are having buy rating in the company. And importantly, also, the important thing is the stock has corrected, if you look at it, from the August highs by almost 7 to 10%. So it'll be very interesting to know going ahead, especially on their cost optimization and volume growth front, because overall, their premiumization strategy, they have actually lost their market share as per channel checks.
Thanks very much. That's Bata in the spotlight. But let's move right on then. Lots of other top stories to track. And here are the headlines that we're tracking across the globe. The U.S. House of Representatives ousted Speaker Kevin McCarthy in a historic vote. For the first time ever, the chamber has actually dethroned its leader with a no confidence vote. McCarthy was removed after party infighting and rebellion over the cooperation with the Democrats for the passage of funding bill. And according to reports, social media giant Meta is planning to lay off employees in its metaverse-oriented Reality Labs division. The quantum of the layoffs is unknown, but the announcement may come any time today. Meantime, OTT and entertainment is only going to get more expensive. Netflix reportedly plans to hike prices of the ad-free services. Netflix is going to issue the price hike. This comes after the Hollywood actors' strike ends, which could happen in the coming weeks. The price hike is going to be first implemented in the US and then in Canada.
And amid the raging diplomatic row, New Delhi has now told off Ottawa to withdraw about 40 of its diplomats to bring parity with the Indian diplomatic presence in Canada. India has about, remember, 20 diplomats still in Canada, while Canada has 3 times more than the Indian presence, about 60 diplomats. And Delhi wants the diplomatic strength to be equal in both the countries.